Welcome to Scope Portfolio Manager Conference. My name is Manqing Sun, Mutual Fund Analyst from Scope Analysis. For our session today, I'm very honored to be joined by one guest speaker. Joining us on the line from Lugano, Switzerland today, we have Jian Shi Cortesi, Investment Director at GAM Investments. She is the lead portfolio manager of both GAM Asia Focus Fund and China Evolution Fund. Good afternoon, Jian. Great to have you with us.
Happy to be here.
So our webinar today brings down the curtain on Scope's Asia Investment Special Series. And this time we tap into Asia equity market. The main objective is to help our investors to stay ahead of the curve and get ready for the next decade by looking into some of the mega investment trends in a continent that will be home to 2/3 of the world's middle classes with rising income. So here's how the hour is going to work. We will break it into two sections where Jen will first provide a snapshot of the landscape of the equity market in Asia, the investment universe, so to say. We then discuss about the investment themes and trends where Jen see attractive stories could play out for the region in the next 10 years and explain the logic behind. We will also cover the portfolio construction of the two funds the team is currently managing, which are impressively topping their peer groups. And of course, we will also address some of the questions regarding recent regulatory crackdowns in China and its implication on the market. Looking into the future, we will discuss where geopolitical tensions between US and China will take us, as well as the growth outlook in the region. We have received many questions and requests for comments prior to the webinar. We appreciate it very much, and I just wanted to know that we will try to include all of them into our session today. And following that, we will open a Q&A session. Before we begin, I'd also like to remind our listeners with few logistics. We'll have time for your questions. So please submit your question anytime under the section Fragen. And finally, a webinar replay will be made shortly after the live event. You could rewatch the clip on our Scope Explorer at any time you want. So, Jan, before we dive deeper into our discussion today, a few words about yourself, your role in GAM, and what's your background relevant to the region and this asset class in particular?
Thanks, Manqing, for the introduction, and thank you everybody for being on this call. So a little bit about my background. I was born in China, and I grew up in China. When I was doing my bachelor's in Beijing back in the 90s, I started investing in Chinese stocks and fell in love with stock investing. And then I worked a couple of years for Dow Jones in Beijing, covering Asian markets. Then I went to the US, did my master's in the US, worked as an equity analyst and investment strategist for Asian equities. Then for the last 11 years, I've been working at GAM as a fund manager, focusing on Asia as well as China equity.
So we see that you have a profound experience starting very early in investing in Asia. Could you maybe provide some broader context and give us a snapshot of the market, of Asia equity market? Just think about your investable universe. What's that look like? How big is that? I'm also very curious about what that sector composition looks like.
Sure. Since I started looking at Asian equities, we have seen tremendous changes in the market. Back 20 years ago, a lot of companies are much smaller, but today Asia is a huge equity market. Just China alone is the second largest equity market in the world, right after the US. And also the Hong Kong market is very big, the number 5 in the world. So when you put all of Asia ex Japan together, it's very big. We have hundreds of companies nowadays with market cap above $1 billion. We have also seen the sectors that have changed. 20 years ago, the biggest sectors were telecom, maybe commodities and banks, financials. But today, the larger sectors in the universe are more consumer and technology related. And I think, however, a lot of investors are not yet aware of this tremendous change. And Asia today is still one of the fastest growing region in the world in the very hello?
I think there's a small hiccup. Yeah, please do continue. Oh. I'm sorry for the technical difficulty. I think Jian will be back on soon.
Hello?
Hello? Hi. Hi, Jian.
Okay. I think we're back online.
Yeah.
Yes. Okay, let's continue. So Asia is an ample ground to hunt for rising star companies, particularly in the consumer and technology field. And Asia is still quite underutilized by investors. And I think as investors start to realize that and start to purchase more Asian equities, it is also positive for the performance of the region.
Yeah, I think let's take a look at your GAM Asia Focus Fund on our Scope Explorer. The fund has a very impressive risk reward profile, top-notch rated number 4 among 100 funds, beating some of the strong names in your peer group. I mean, what do you think make this fund stand out compared to your peers? I mean, speaking from a somewhat skeptical point of view, given the nuance across the countries in the region and corporate governance issue, data quality issue, is that a difficult environment for you to invest in general? What are the challenges for you to navigate in this market?
I think in general, the challenges for investors is that Asia is a very big market with more than 10 major countries, and they have very different characteristics. For example, Thailand is very different from Korea, and there are also 11 sectors in each of these markets. And as you mentioned, the local knowledge about Asia is critical for investors to do well in this region. And when it comes to our strategy, I think that the biggest contributor to our success is that we have carefully designed our strategy to generate very consistent alpha. Most of the Asia funds either use a pure top-down approach or a bottom-up approach. But in our approach, we have a unique 3-pillar approach where we use a top-down model to decide on the country allocation. And then we use the mega trends to help us decide the sector allocation, the sectors that we want to focus on. Then based on our proprietary winning stock framework, our stock selection is our 3rd pillar. So in a single year, if the country allocation doesn't work out well, maybe the sector allocation and the stock selection still do well. So when we put all 3 pillars together, the result is one of the most consistent performance in the peer group. We have outperformed almost in every year, and the worst year we performed similar to the index. And in addition to that, if we look at some of the big winners in the past in our portfolio, many of them are winning companies that we saw before other people see them. And these are the companies that we're always actively looking for.
So there's a question like from the audience asking about, is it a talk only or is there any slides? And I just wanted to just to answer that question, we have prepared slides and it's very collaborated. So just wait till our question run down to that point. And so let's move on to the main topic of today's discussion. What are the main drivers for growth across regions in Asia? How does the country and sector allocation look like in your portfolio right now? Especially how that sort of matches up against the vision that you and your team have as the investment trends in Asia for the next decade. Could you maybe give us some concrete examples?
Sure. Since let's go to slide number 7. It's good to use some of the charts to facilitate the discussion.
Yeah, thanks. Thanks for the audience.
Yeah. So in our philosophy, we believe that it's very important to stay with powerful long-term trends. And in Chinese, there is this saying, when there is a very strong wind, even pigs can fly. So we want to be where there's a strong wind. And we know that from 2000 to 2010, we had globally a commodity bull market. And back then, the best places to invest in Asia was also energy, materials, and construction. Since 2010, the global economic driver has become consumption and innovation. So this has been the area that we have been focusing on. And Asia is also a great place to invest for consumption and innovation. As Manqing already mentioned, that by 2030, Asia will account for 2/3 of the global middle class consumers. So it's a very vibrant consumer market and with a lot of attractive companies for investors to profit from. And in terms of innovation, I would say in globally we have two big camps. On the one side, we have US companies that are very strong. And then on the other side, we have a big cluster in Asia. We have Korean and Taiwan hardware and semiconductor companies. We have a lot of large Chinese technology companies and also IT services leaders in India. So this is a great place for us to invest in consumption and innovation. And when it comes to our portfolio currently, the largest exposure we have, consistent with our sector focus, are related to consumption, technology, and also some internet stocks, as well as some healthcare stocks. And in addition, we also have some names related to wealth management, insurance, as Asian consumers are becoming increasingly wealthy. And another area that we like very much is the clean energy. And Asia is a clear leader in clean energy. Just take the electric vehicle battery. Asia accounts for about, I think, more than 80% of the global production. And the electric vehicle, for example, is also opening a fresh opportunity for Chinese players to be, as good as the European car makers. So these are some of the areas that we are focusing on and we believe will generate very good investment opportunities for investors.
Mm-hmm. So there's another question popping up regarding Soros' recent comment on China. I just wanted you to know that we will cover this topic in the later session. And first, let's maybe zoom into a little further into your portfolio. From the attribution analysis, we see a strong stock selection capability of the team, which we assume is the main source of alpha. And your portfolio is mainly growth-oriented. How familiar are you with value holdings? Because over the last month, we've seen some pressures on growth stocks from rotations to value. How long do you think the rotation will last, and what's your expectation going forward in terms of style and maybe a few words on the valuation too?
Yeah, sure. We can go to page 9. Mm-hmm. So in our portfolio, when it comes to stock picking, we use what we call the winning stock framework. And this framework is developed by studying successful past investments of investors like Warren Buffett, Peter Lynch, and put them into categories. And when we pick stocks, we are looking for stocks that have similar characteristics. We focus on the growth sectors, consumer innovation. However, from time to time within the growth sectors, we also have opportunities to invest in value type of stocks. And here we are very selective. We selectively invest in certain type of value stocks. For example, ignored blue chips. So these are very good companies with good operating metrics, not really any issues, but maybe the sector is out of favor and the stock is trading at very low valuations. Or we look at hidden asset value. But we don't buy companies with problems that are just cheap. And also we do a lot of turnarounds or the recovery plays. And these are oftentimes also in the consumer and technology field. But every industry within that big space has its own cycle. For example, last year, after the March correction, many stocks became quite inexpensive. And we noticed that the auto sector in many Asian countries are at the trough of their industry cycle. So we went into the auto stocks in China, in India, and in Korea to play the automobile industry recovery. And that has helped our performance quite well late last year. And of course, we have many names under the growth type of stocks or the quality type of stocks. So I would say in general, our portfolio will have a growth tilt when growth is cheap because we use valuation as our guide. And earlier this year in Q1, we noticed many high growth names have become fully priced in our view, and we have taken profit. And as we take profit, the portfolio's growth tilt goes down. But when growth names become cheap, we will load up on the growth names and we'll have a heavier growth tilt. So in short, I would say that our portfolio is more growth when growth is cheap, and it's less growth in terms of a style tilt when growth is expensive. And this is also a key reason that has helped us navigate the style rotation, sector rotation, bull market or bear market over the last 7, 8 years, and to generate a consistent performance.
So one of our audience is asking about the font ISIN number. I think I can provide you after the PNC. That's a good question. Could you provide some examples for companies that you were invested in?
Sure. We have companies, as I mentioned, in the telecom in the technology space, and here, for example, we have the semiconductor companies in Korea and Taiwan. We also have semiconductor equipment manufacturers in Korea and Taiwan. And as we all know, we have a shortage of semiconductors, and we are in a time where everything is having a chip inside, and there is tremendous demand in that space. And we also, in the other technology field, we have also, for example, data security companies. There's also a huge demand for that going forward. And in addition, we have in the consumer sector, the consumer names that are especially doing very well, meeting the needs of the millennial consumers. For example, in China, in the sportswear space, we have companies that are um, profiting from this national wave in China, where the young people like the domestic brands and they feel proud of their Chinese heritage. So these are some of the names that we have in the portfolio.
So let's come to China. I mean, in addition to Asia Focus Fund, we know that you're also managing the game China Evolution Equity. And maybe you would like to weigh in on the recent regulatory crackdowns in China. I'm sure it's a question on everyone's mind right now. In fact, that's also reflected from the questions we receive from the audience right now. It all boils down to one question: is China still investable? And also, what's your take on George Soros' recent comment? I believe the original words is depressive versus democratic. I mean, what's your take on that?
Maybe first about George Soros. I think his comments is very much political rather than investment or economical. And I think from his personal background, that he used to be in Eastern Europe, and then he went to the U.S. because of the situation in Eastern Europe, the regime, etc. So I think everybody's view is impacted by our personal experience, and so I could understand that why he's making very strong comments against China. However, I wouldn't consider that. I think he is of course a really good investor, but he's not necessarily an investor that has according to my knowledge, he didn't make most of his money from China. So let's look at the page 2 to see what is really the thinking behind all of these recent regulations. There have been many speculations in the media, So there is one thing that's very clear to us is that all the recent policies are related to a change in policy. The policy is changing from let some people get rich first to common prosperity. So when China started the reform 30 years ago, back then everybody was poor. So the policy was let some people get rich first because you cannot let everybody get rich first. And that has worked very well in China. Today, we have some very rich people in China, and the richest 1% of the Chinese owns 30% of the wealth, while the poorer half in China owns less than 10% of the wealth. So that is creating some social tension. And we see the similar dynamic in many other countries. For example, in the US, the richest 1% owns 35% of the wealth. And in Germany, that number is also close to 30%. But in many countries, the frustration towards the wealth gap was channeled into elections where people elect populist governments, or they elect a new president and hoping the policy would change. And in China, the Chinese Communist Party has always promised that their role is to serve the people. And this is mentioned everywhere in the party's policy. And therefore, it is critical for the Chinese government to address this common prosperity. And the wealth gap is also negative for GDP growth longer term, because today in China, there's a very hot phrase among young people. It's called lie flat, meaning that I just lie down and I don't do anything anymore because I don't see hope. If I work hard for 30 years, maybe I can buy an apartment, or maybe I can still not buy an apartment. So what's the point of working hard? So obviously, if a lot of young people have that thinking, it's not good for the economy going forward. And on the next page, the very key point about common prosperity is that it aims to create a harmonious society, meaning not a lot of social tensions between the rich and the poor. And it is not just about material wealth, but also mental well being and the right social values. And it's about resources and opportunities shared fairly among all people. So poor people or young people that are starting out feel that they still have a hope for having a much better life in the future. And the policy stated clearly that it is not about equal wealth for everybody. Because in China, in the past, we lived through that, and equal wealth doesn't lead to common prosperity, it leads to common poverty. So rather, the policy is about the rich helping the poor prosper. And if we go to the next page, now I hope we understand the rationale behind all of these new regulations and the policies. It's the key question is, can Chinese companies still make profit? Can they still prosper? And I'm quite confident that they can. And Chinese companies have always adapted, and I think they will continue to adapt. uh, it means that companies have to avoid generating profits through unfair practices, such as not paying employees social contributions, using false advertising, or monopoly power. And companies also have to put people first. Keep your customers and employees happy. Otherwise, when customers complain, you risk the government investigations. And finally, help the government achieve what they want to achieve with common prosperity. Build businesses in the rural areas, in the inland regions that have low income, and employ poor people, teach them skill, and help them prosper. When companies do that, they will get a lot of government support. And if we boil it down, it's actually what the social pillar in ESG promotes. And I believe when companies behave in this way, they can continue to prosper. And the most important thing is that um, in China, the the very important goal is still economic growth, because the common prosperity policy is about how to divide the pie. But before dividing the pie, we have to have the pie. And in order to have the pie, we have to rely on private companies to grow the economic pie. And private companies are also key in creating new jobs. They create 90% of the new jobs in China. And private companies are also key in helping China winning the technology battle against the US. So, because of all of those reasons, China, I believe, will not suppress private companies, and it cannot afford to do that.
Yeah, I think it may seem like those are like those policies are idiosyncratic policies, but if you take a step back and look at the bigger picture, there is always a thread running through the common theme when it comes to investment in China. We all know that the government very much values social economic stability, and with that in mind, I think you can see the common theme here, and that is working on improving the social stability and income disparity. And also the question how to regulate big techs and promote competition, how to bring education costs down, how to drive speculation out of the property market, and how to protect your data. These kinds of discussions actually takes place everywhere in the world, and you can easily draw some parallels between what is happening towards Google, towards Facebook and Amazon's in the US, and to Tencent and Alibaba in China. And for years, there's been a lot of criticism actually towards China in terms of lack of compliance and regulatory oversight. So in the spirit of the reforms that everyone's asking for, and in the longer term, I think this probably creates a better environment for global investors in a few years. And of course, the execution could always be better. The communication could have been better. Very similar problems, but one is set up to deal with them more directly, decisively, and also more quickly, which certainly I think caused the short-term pain in the market in terms of volatility and in terms of this drawdowns. So my next question follow-up in terms of this volatility and drawdowns is that in one of your previous interviews, you mentioned panic cycle about regulatory intervention that dislocate the market, looking back in the history of China. For audience who are not familiar with this term, panic cycle, could you elaborate?
Yes. By the way, Manqing, you summarize it really very well. I think it's as as you have said, all of these regulations, I think, is actually creating a more level playing field for companies that behave well, and also for the emerging companies to rise. And as I mentioned, the rising star companies, those ones that are still early in the growth stage, has been a key contributor in our strategy. So I think these anti-monopoly is actually creating more opportunities in the areas that could benefit our strategy. And in terms of this panic cycle, if you go to page 5, we have a chart showing the MSCI China index. So this is the page 5, sorry. The one before. Yes, the stock price chart. So on this chart, you can see the Chinese stock price, and we can clearly see this policy cycle that corresponds with the market cycle. In 2015, there was the tightening of stock trading, and back then um, there were companies providing 10 times the leverage to investors to allow them to trade with huge leverage. And the government tightened on that. In 2018, there was policy tightening on games and education. And this time, we have seen a series of regulations related to common prosperity. And you can see that in each time, China equities market had a big correction. And this time, the degree of correction is already similar to the previous cycles. And in my view, this creates an opportunity for investors to buy in China at much cheaper prices. And in fact, we are seeing a lot more opportunities now in the market with the companies that we like in the consumer innovation space, and the companies are trading at much attractive valuations. And in Q1 this year, we have reduced the risk as we took profit in some of the high growth names. And in the coming months, we will be adding risk in the portfolio as many of these stocks are becoming attractively valued.
So you and the team are viewing this volatility more as an opportunity, or is it too early to tell? What are the signals or catalysts that investors can look for to, as a sign of restored confidence?
In our experience, that when there are clear signs of supportive policies, normally the market has already rebounded quite a bit. The market bottom is when the fear level is at its peak. And by definition, that's when everything looks very scary. So for us, the guide to our action is valuations. We believe that if you buy stocks in the growth sectors in consumer innovation where the company can grow above average, and then if you pay a very attractive price for those stocks, there's a very high probability that we will make money.
So another question our audience is extremely interested is US and China. I mean, the financial decoupling and the tech rivalry between those two countries are most likely to sustain, which brought many industries to the center of the battlefield. What are the opportunities here for global investors in this regard?
Yes. So we are moving from a one power global order, which was the US, to a now two power rivalry global order. And if we look at, you can actually go to page 11. And today, the Chinese GDP is already more than 70% of the US size. So the two countries are similar in size, and it's easy to understand why US is using various ways to deter China. And I think we will be in multiple years, could potentially be 10, 20 years of rivalry between the US and China. And in this rivalry, China wants to win the economic battle and the technology battle. And if we look at the US strategy under Biden, it is to line up the allies. And for China, China doesn't have many powerful friends in the world. So it's also related to the recent policies. I think the thinking is the strategy is to line up the domestic forces, including companies and the general public. And the recent measures is gathering a lot of support from many, the population, because a lot of these industries have been getting complaints. And for investors, this rivalry means that China will have to increasingly focus on domestic demand while the external environment is becoming less friendly. And also China has to focus on technology independence. When the US cut off semiconductor supply to Huawei, it cripples, one of the largest technology company in China. So the opportunities is definitely, in semiconductors here, not just domestic Chinese companies, also Korea and Taiwan companies are benefiting. And also companies that are related to import substitutions in China, especially in the high tech area and high end manufacturer. And then amid this rivalry, I think inside the U.S., probably Americans would support their countries naturally, and also in China, the Chinese people are becoming more patriotic, and this is generating a national wave in the consumer market, where in the past many young people, they want to buy Nike shoes, Adidas shoes, and today they feel proud to wear Chinese brands, for example, Li Ning or Anta. So that's creating
Yeah.
Exactly.
Exactly. That's
Yes.
what I heard. Yeah.
Right. So we see this dynamic in shoes, in the food, also in many, for example, in cosmetics. A lot of Chinese people in the past, they focus on using international brands, and now there's an increasing shift towards domestic brands. So that creates opportunities. And another field that China is already leading, and I think will continue to work on to widen the leadership gap is the clean energy. China is the leader in wind, in solar capacity. China accounts for about 40% of the global capacity, and in wind, it has a similar share. And electric vehicle battery, China is also a leader. So I think these are the areas that China will put increasing efforts into. And in our portfolio, actually, this year, we have had a very positive contribution from solar equipment company, wind turbine producers, as well as clean energy companies.
So another question on the regulatory moves that have raised concerns over this variable interest entities, so-called VIE structure, and the delisting risk of Chinese ADRs. We saw this threatening from the SEC and also the data-heavy tech firms are banned for IPO in the US from Beijing. Could you help us to assess the regulatory impact and maybe highlight some development addressing this topic? And I think there's also a question from the audience that is, it's talking about whether it has impact on the growth stocks and growth style in general.
Yes, I am. So there have been a lot of news regarding the regulation, as you mentioned these points. So in short, the VIE structure, companies that are already using existing VIE structures, I don't think it will be a problem. And going forward, many new listings will probably avoid the VIE structures, and eventually there will be a solution found about this. And in terms of US wanting to delist Chinese ADRs, I think there's a probability that maybe it would not happen eventually. However, even if it happens, it's not a big deal because most of the Chinese ADR companies have already done secondary listing in Hong Kong. So these shares are fungible, meaning if you hold Alibaba in the US, you can convert it to Alibaba's Hong Kong shares. They trade at the same price. There's no economic impact. So we have already seen many companies many investors shifting their holdings to the Hong Kong listings. And for those Chinese ADRs that haven't done the secondary listing, I expect them to do so in the coming months in Hong Kong. So once they're all listed in Hong Kong, even if they are delisted in the US, it's not an issue. And it would also not really impact the valuations. For example, Tencent is only listed in Hong Kong. It doesn't. It's not. It has a very thinly traded US ADR, but in that case, it doesn't really impact the valuation of Tencent because at the end of the day, the valuations of stocks are determined by the cost of money and the growth rate of the company. And if we look at Chinese A shares for years could only be traded by Chinese investors, and US investors and European investors cannot buy them. But that doesn't prevent them from trading at sometimes very high valuations. So in short, I think these creates a lot of noises in the market and generate a lot of fears. And some investors say, I don't understand this, so I just won't touch it. And as a result, it has resulted in the growth stocks being sold off. But over the longer term, the stock price will be driven by the revenue or the earnings generated by the companies. And as these earnings continue to grow, the value of the company will continue to grow. So these volatilities, in our view, are clearly just opportunities for investors who can understand to take advantage.
So outside China, in Asia, actually, tech IPOs are having a record year with growing representation of new economy companies in Southeast Asia and India. What to look for from there, and how would it impact market in terms of valuation?
Yes, so we are seeing a lot of new opportunities coming from Southeast Asia and India as the technology or the internet companies there. The development is probably 10 years behind China. So many of the things that has happened in China internet is not happening in India and Southeast Asia. And a lot of these companies have backings from Chinese internet companies or global internet companies. So we expect to see many opportunities in these areas too. And we have in the past already invested in some of these internet names in the other Asian countries other than China.
So a quick follow-up question from the audience. When you address the domestic, focus on domestic theory for China, what does this focus on domestic mean for foreign investors? I mean, the concern is that the investors outside of China would be like thrown under the bus, quoted, when it comes to regulatory changes. And he mentioned a recent case of Evergrande that the financial regulators from China publicly asked the Evergrande, the largest developer in China, to fix their debt.
Yes, I think I think it's difficult. First of all, I don't think China wants to throw international investors under the bus, because imagine if that happens, nobody would ever buy Chinese securities. And this is obviously not what any country wants. And it will be doing something very stupid. And even if, let's say, they want to throw the foreign investors under the bus, it's difficult not to negatively impact Chinese investors, because in many securities there are holders both with of foreign investors and domestic investors. And so in terms of Evergrande, this is really market driven. Evergrande is the heaviest leveraged Chinese property companies for years. And we have always been, staying away from that company because of the huge risk that they take. And that is why the Evergrande bonds in the past offer such a high yield. So with the higher yield comes with of this higher risk. And I would say it's an isolated case, and it is really the credit related to the yield situation. And then when the company has an issue, of course, there is the credit problem, maybe that they are not able to pay back the bond, and the people that bought the bond hoping to get a high yield would have a negative result.
Yeah, as for Evergrande, I think it's always like been a great rhino. We all know that those real estate companies there in China are heavily indebted, and eventually this will be solved. This problem would need to be fixed at a certain point. So my last question for you before we take some questions from the audience, or I think we've covered all. Where do you see the biggest tail risk? Taper, inflation, COVID policies? I mean, looking into your crystal ball, what's your view on the growth outlook?
So in terms of COVID, I think it has only a lingering impact now. So it's probably not going to be a key driver. And in terms of inflation, China has not pumped huge liquidities into the system because of COVID. So inflation is not an issue in China. The CPI numbers are all fairly low. So I think probably the bigger risk is more the tapering in the US. And in terms of domestic growth, I think Chinese domestic growth will be under pressure. We will see the economic numbers deteriorating quite rapidly because of all the recent regulations. When government tightens policies, business people normally get scared. And when they get scared, they stop investing. And then that would drag on the economic growth. However, in this case, the slowdown would be policy driven, and it will also be easily reversed by putting out supportive policies. And my base case is actually that Chinese government will soon be turning very supportive in terms of policy.
So I was looking at the questions in the audience. I think we have time for one. That is So even if I was trying to process the question, even if neither, it's addressing the VIE and delisting threat, I think. Even if neither the US nor PRC make use of a nuclear listing, a nuclear option like delisting, isn't it the fact that the contracts of VIEs are not enforceable with a practical example of Yahoo being striped off their 23% of Ant financials by Ma, settled at 6 billion instead of some 140. And as Barron's, Bloomberg, etc. report on it, and US institutions want to get out, isn't that enough for Baidu, Alibaba, JD.com, Tencent to continue to fall?
I'm not sure I understood the question 100%, but I think that the risk again, by the way, the delisting of the US will not be catastrophic. As I mentioned, once these companies are listed in Hong Kong, delisting them in the US will be pretty much very little impact. Imagine a German company is listed in Germany and the US, and then they stop trading in the US, but they will continue to trade in Germany. So it's for investors, you just simply shift your holding from the US ADR to the Hong Kong listing, and so. And in terms of Alibaba's Ant Financial, I think this is a special case. And when that happened, it was because China had a rule that foreign capital cannot be involved in the financial business without the right approval. So in that case, Ant Financial was split off out of Alibaba. But if you look at Yahoo, actually, I would say Alibaba is the best investment Yahoo have ever made. Yahoo put in $1 billion, I think, in 2005 into Alibaba, and they got multiple times out of that. And that is the reason why foreign capital continue to go into China, because at the end, there are companies like Alibaba, Tencent, Baidu, there are 30, 50, 100 other companies that started from zero, sometimes 10 years ago, 20 years ago, or even 5 years ago. And today there are $100 billion companies because China is a vibrant market that allow these companies to rise and allow the original investors or the investors that bought later to generate tremendous return. And that's why investors are there. But I think, from time to time, investors panic because they think that the Chinese government is going to do something. And the bottom line is that no government can do anything without consequences. So, every measure you take would have, if a country defaults on the debt in the coming years, they will not be able to borrow. If a country, throw in foreign investors under the bus, nobody will buy their securities anymore. So this is the bottom line. And when it comes to investing in China, the key is to find companies that can grow, that are doing things in the ESG way, that have low risk, and then as they grow, the value grows and the stock price will follow.
Mm-hmm. Unfortunately, I think we have to stop here in the interest of time. And I think for the questions, we will follow up on that definitely. A very big thank you to Jian Shi Cortesi. Thank you for being here and for this insightful talk. It's been also an eye-opener for me. So, yeah. As global investor in emerging market, you always have to be nimble, and you just don't take things for granted in terms of the macro backdrop that you're invested in. And this is essentially why active management matters so much in emerging market, especially Asian markets. You need someone to translate those information for you. And I hope you all leave better informed and potentially feel excited about the opportunities in Asia for the next decade, like we do. I hope you will enjoy today's webinar and have a wonderful day. See you next time.
Yeah, thank you very much.